Hi, guys. Welcome to a new episode of Let's Talk. It's the podcast of two great investors, Demetris and myself. We're two popular investors on eToro, and we are here to discuss the do's and don'ts of your portfolio strategy. And today with Demetris, we'll discuss what we like to do and what we like to avoid in our respective portfolio strategies. So, Demetris, tell me, you have a very successful portfolio since inception. You've been outperforming the stock market. I double-checked the stats a few days ago. This is something quite rare. You've been outperforming it really since inception. So that's now, what is it, the fifth year, I think? No, the
This is,
fourth.
this is the
It's
fifth
the
year.
fourth year, the fifth year.
No,
4 years.
it's going to be 4 years in July, but it's 5 years of stats.
5 years of stats, and you've been outperforming the stock market. So what is your biggest do? What is your biggest tip for someone who is starting to invest and is not 100% confident, right? Is not 100% confident what to do with the portfolio? What is like the biggest do?
So number one for me is to start small. Don't go all in from the beginning. I understand you make the decision to start investing. You want to prepare for your future, for your retirement, whatever the case may be, and you have $10,000 to invest. Jumping with the whole amount while you don't understand the ins and outs of the industry, I believe is a mistake. So you start small, you go with 10, 15, 20% of the amount. Get used to the volatility. Try to understand what happens when the market goes up and down, when they're reacting to the news, when they're reacting to the Fed, all the information related to it. And then you take it one step at a time. And to be honest,
Let's be a bit more precise. When you say start small, let's say someone has I don't know, 20,000 euros of savings.
Yes.
Starting small, do you mean to take a small amount of those 20,000
Yes.
to start and to not invest any more money? And how small should it be?
So if you manage to save $20,000 by working, I think you should risk initially just $5,000. And then after a couple of months, if you see that your selection process was correct, you didn't panic in the latest pullback or correction, and compare yourself to other people and what they do, even though comparison is not a good thing, then you add to it. But just jumping in $20,000 right away and you don't even know how the whole things work, I believe it's a mistake. Because the first sign of volatility, and I'm talking about volatility, your stock reporting earnings like yesterday, like Meta, beating bottom line and top line estimates, and it went down by 15% in the aftermarket.
Yes.
To hold that the next day, or you're going to be selling as soon as the market open.
Yes, for background, Meta beat top and bottom line expectations, and the stock market dropped.
Yes.
Tesla disappointed from all fronts.
Yes.
But the stock is sharply up.
Yes.
Right? And someone who has a selection process based on, let's say, value and good news, that person who would have invested his 20K or her 20K on, let's say, Meta, because Meta, wow, good news, it's going well and Meta is having troubles, you would have lost those 10%, right? Yes. And you would have missed the other 10% from Tesla. So there is a 20% loss, actually. The 10% loss plus the 10% opportunity cost, let's say, right?
Absolutely.
And that shows that the market is a little bit irrational in the short term.
Yes.
And that's why you should be invested with a long-term perspective. So you don't need to go now with your 20K all in, right? You start with 5K. You're anyway here for the long term. You're here for the next decades, plural, next decades. So you don't need to start with all your savings right now, right? This is what you're saying, Demetris, if I understood you correctly.
Exactly right, sir.
Yours.
What is your number one? Your Bible.
My number one, my Bible. So I try not to talk too personal, but I think being an investor, yes, you have to be objective. Yes, you have to be logical and square. I do think that you still cannot remove fully your personality as a person, as someone who has a personality, your own character.
Yes.
In my case, my family is from a bit farmer background, right? My father is from a farmer family, and since the young age, we learn to be humble at all times. And this is my biggest tip as an investor, to be humble at all times. It doesn't matter if you're outperforming or doing better than someone or doing better than an index or even doing better than yourself based on stats or whatever. Don't always be humble. So let's say if you have those 20K and you're very confident in yourself and you think that this stock is a fantastic stock, it will grow because you did the research and you are smart, you have a PhD, and in the past you've outperformed everyone, and you say now let's go all in into that one stock that I selected. You might lose everything
That's
that
how
you
you get
worked
in trouble.
for. And even if you outperformed in the first 10 years, if you screw up that one time where you're overconfident, everything is lost. And
Yes.
that's why my biggest tip for the long term is to be humble at all times. You're always learning, you're always on a learning curve, always in a learning process. Other investors with a priori worse performance can have interesting insights. There can be interesting things you can learn from other investors. And maybe not a lot of people know that, but Warren Buffett, everyone knows Warren Buffett,
Yes.
how he's a fantastic investor. He
But
actually underperformed for many years in the beginning,
Mhm.
but he was patient. He was patient not only with his stock selection, but he was patient with himself.
Mhm.
Him and Charlie Munger, they always say that what they're doing is they're always trying to deconstruct what they learned. So what they learned, they try to challenge and to keep learning. And this is really the most important. Be humble at all times. That helps you to continue learning, to be patient with the market, to be patient with yourself. So when everything crashes, just chill, relax, learn, see what's going on, try to understand. Don't panic. Just try to understand. Be humble. Maybe you made a mistake, maybe not. Uh, so just be humble at all times. This is my biggest number one do. But being an investor is maybe not only about the do's. We will come back on other do's, but it's also about don'ts, right?
Yes.
It's also about don'ts.
Those are actually
And
more important sometimes.
and
Try.
yeah, perhaps it's more important sometimes.
Yeah,
And the go ahead.
on your eToro profile, you
Ah,
said
yes.
it's important to know how not to screw up. What is the code exactly?
Uh, the performance of an investor over the long term is determined on how many times you did not screw up. So
Exactly
that
right,
means
sir.
on how many times, and this is related to actually being humble. This means that it's related to how many times you were tempted to perhaps give up or perhaps go all in into one asset because you've been outperforming in the past and you're like, okay, I'll put all in Bitcoin hoping I recover.
Yes.
This is something that might make you screw up.
Yes. Absolutely. Absolutely.
So
And
what would be your biggest daunt to not screw up, to limit the possibility of screwing up?
okay, so I have a list. I have a list. And I have number one, number two, and number three. Okay. So I'm gonna say number two. Number two is do not take advice, investing advice, stock picks, whatsoever, especially from people that don't follow the stock market.
Who do you have in mind?
So, first of all, it has to be your own convictions. Okay, if you're gonna go all in on Bitcoin and lose everything, that's fine. But don't do it because your taxi driver told you that Bitcoin is going up. That's number one. Number two, if you don't do this the way I do it, in the level I'm doing it, the information I'm consuming every day, the amount of time I'm spending reading and watching press conferences, that your opinion doesn't interest me. I don't care if you have more money than me. I don't care if you are a multi-millionaire. If you don't follow the stock market, your opinion is useless to me, and I won't hear it. I'm not going to tell you to stop talking when you say it to me, but I won't take it into account. And one thing that comes to mind is, obviously, people know what we do, and they see us at the gym, our friends, and they say, "Oh, how is the stock market?" I say, "The stock market is fine." "Oh, I heard it was a bloodbath the other day. It was like down 2%. You know what I mean? So someone that doesn't understand the in and outs, and I go back to my number one do, start small. Then these things can affect you, can affect your judgment. So it has to be your own convictions. If you want to go all in, or you want to choose a strategy that you go long, short, it has to be your conviction, nobody else. You don't listen to the people on the media, and especially the people in the media. The people that just sit there, and the topics that come in front of them, topics of the day, they haven't done any background check. Jim Cramer. I don't want to shit on Jim Cramer, but his show, Mad Money, you watch the show, I watch the show too.
Yes.
Somebody calls him from New Jersey, say, "Hey, Jim, I own this and that." And he has to answer hold, sell, or buy within 2 seconds. It's impossible to make a correct call in that scenario. So Jim Cramer gets a bad rep sometimes, but I understand the position he's put in. So try to avoid all that and go and do it your own way correctly.
Yes, unfortunately, very often when you read the newspaper or when you're listening to TV, watching TV about the stock market, even from professionals, they are heavily influenced by the performance of the index as of today.
Yes.
So if you watch the same show yesterday, and let's say it was a flat day, but let's say yesterday it was a very green day, you will hear a lot of positive stuff. Inflation is going down. Yes, yes, we're going into a normalization of inflation. Interest rate going to be cut. This is bullish for stocks. A lot of positive things. And if today the stock market is very red, so falling sharply, you will hear a lot of things. Oh my God, what is happening? Maybe the US companies are not as solid as we thought. Maybe Chinese competition is too strong. Maybe the oil price is up by a couple cents today. Oh my God, there's a new inflation rebound. So they are heavily biased, the media, but this is because it's their job. They have to react on the news of today. It doesn't matter what happened yesterday. So that's why you have to be careful, actually. And this comes to my second don't. So I think it's a good to my first don't, actually. This is a good transition. And it's again a bit of a farming anecdote. If you have a garden, I don't know, Demetris, I don't know, I guess in Cyprus maybe it's not that. You live in a big city, right? In Cyprus, maybe you don't have a garden.
No, I live outside of the city, but I live in an apartment. I don't have a garden, but my mother has.
Your mother has. What does she grow there? Does she grow things?
No, we don't grow anything. We only have palm trees and flowers, nothing of.
Nonetheless, it works also with flowers. But if you have a garden and you grow things, one thing that every good gardener would say, and I'm sure your mom knows, is that if you plant some seeds, you have to leave time to those seeds to grow. So you should not cut too often. You should not cut and plant new seeds, plant new seeds. Oh, it's not growing fast enough. And then plant again, cut new seeds. And this is one of my biggest don'ts is don't trade too often. Yes, you can rebalance your portfolio in terms of weightings, put a bit more on that stock, put a bit less on the other stock, but do not open and close your positions too often. Also based on what you hear on the media, in the media, if you buy a stock today and tomorrow you hear bad news or you hear someone talk about it or Jim Cramer talk about that stock, say, sell the stock, don't sell it. Calm. You chose it for a reason. Give it time. I always say, start investing, for example, beginning of the year, but leave it the whole year. Leave your portfolio as is the whole year. I mean, you can keep investing on all the assets that you pre-selected, but just wait till the end of year, see how it performed, see if you really need to rebalance, if you need to change something, if you need to add more weight to technology or more weight to another sector. But my biggest don't is don't trade too often. Your portfolio is your garden. Leave time for the seeds to bloom, and it helps to wait for the good profits, which then you can start collecting.
So basically, I completely agree with you. And is the quote of Warren Buffett, you can't get a baby by getting pregnant 9 women at a time. You
can't get a baby in 1 month, right? And getting
Yes.
9 women pregnant at the same time.
You have to wait. Sometimes some things they just take time, is what you
Yes.
say. And I'm also guessing you preaching about patience as well.
It's really about patience, yes.
Being patient is the most difficult thing to do in the stock market, I believe, sometimes, because especially if you do this on a professional level, like we are, and you have friends, and you're interested to what they do, and you see, Akim is up 20% on that position. Why am I not in that position? What am I doing wrong? And then, a little bit of envy, a little bit of animal spirits, and then, but you have to be disciplined. So I completely agree with you, and I probably have it. Patience. I don't have patience, but I have another one of my don'ts. It's related to that.
Yeah, which one? What do you have there?
Don't try to pick the timing is my number 2.
Don't try to pick the timing. So you mean that we never know when is the right day to start investing?
Yes. Not only that, is when you betting that if I buy Tesla today, it's gonna go up in the next week because so and so, or vice versa. You shorting Tesla today because you're betting that the earnings report is gonna be negative, even though you have no idea what they're gonna say at the earnings report. Nobody does. The only people that know is the CEO and a couple of more people. And if they disclose that to anybody else, people are going to jail. So basically, nobody knows. Maybe the big firms in New York that can get the information a minute before us, correct? But
Eventually,
eventually,
maybe the insider traders as well, which we know
yes,
is not legal.
yes. But you don't want to be in that group if you're gonna do this for your rest of your life. You don't want to be in that group.
No, you don't. And this is why I wrote also as a do, something that I really recommend to people to do, is that you make a plan, a pre-selection. So you make really a plan, not just pre-selection of assets, but really all the limits. The limits, for example, at what point in time would you sell an asset? At what point in time would you take profit? At what point in time, or how often you would continue buying new shares, right? Have a plan with your set of rules, right? You don't have to necessarily copy the rules of someone. You can, if you do your research, and you can come up with your own plan if that's something you want to do. The most important is you stick with your plan. Make that plan prior to investing. Once you're invested, try to not get too emotional. Sometimes it helps on days where your portfolio value sharply falls. Sometimes it helps to not check it and to just give it a couple of days. We all went through this phase. That helps you to not panic and make bad decisions. In general, I would say make your trades, so buy or sell, when your portfolio is going well. Because when it's not going well, it's a little bit risky because you could quickly lose confidence, lose faith in your portfolio, and you could quickly screw up. The moments you screw up is actually the moments when the market crashes.
Yes.
Those are the most sensitive moments. And the days when everything goes great, we tend to not like to touch our portfolio, but really concentrate your trade movements when everything is going great. You will see you will not trade too often, actually. So my a big do is stick with your plan, and it's also related to what you said, Demetris, and I know you do it actually, is you have a plan you stick with it, even if there is a crash, if a stock crash, if fundamentals are still fine, the CEO is still the same, management is still good, there's no reason to alter your plan like that during your year or to even ever alter your plan.
So I agree with you. And to give a real life example of what we mean. So yesterday Tesla went up 15%, 13%.
Yeah, something around that.
It would be stupid to buy on that day.
Mm-hmm.
And it would be stupid to sell today Meta after the market open, correct?
Yes.
A wise investor would have sold yesterday, got out of Tesla. If he wasn't down too much, most people are, I am too. And the wise thing to do is to buy Meta in some point today. I'm
Mm-hmm.
not saying I will. I'm just saying I'm considering.
I know what you're gonna do, Demetris. I'm gonna see you 2 hours from now. Demetris bought 100 shares of Meta. Actually, funnily enough, related to yesterday, I saw a meme that's really funny. It was a photo on LinkedIn. It was a guy. It got viral on LinkedIn. I will forward it to you. A guy. He took the book from Benjamin Graham, The Intelligent Investor,
I saw
and
that.
he put it in the trash bin yesterday
Yes.
because any intelligent investor
Hmm?
would understand that what happened yesterday is so extremely irrational
Mm-hmm.
that Tesla went up and Meta went down, which is a negative correlation to what actually happened in terms of
Yes.
earnings. And this is why it's really important to stick with your plan and to not panic.
And it's another reason for people to know that investing and successful investing, investing is one thing. Successful investing to make money every year is extremely difficult. So if someone told you, let's say someone told you 2 days before that Tesla will miss top and bottom lines, what is the first thing you do? You short the stock.
Yeah,
And then
that's what a rational investor would do,
yes,
right?
but it
Logical one.
doesn't work like that most of the times. And that's how you get in trouble. And if you were down and if you were shorting and it went against you, oh my God,
Mhm.
you just wiped out a good portion of your profits of the year, and then you're not recovering for the rest of the year. Your year is done basically.
Yeah, yeah. Um, I have one big do. I don't know if you have some more, but I have like one big do that I really uh, recommend to investors who just start. But this is really for everyone, also for expert ones. Is
Mhm.
be realistic in your
Mhm.
return expectations.
Yes.
As we know, but we tend to forget, the historical average return of the index is around 10%,
Yes.
slightly below 10%.
10%. Yes.
Which means that okay, first year maybe you did plus 20, but it is likely that in the next couple years you will have some difficult years that will make your portfolio come back to the average of 10% because even the best investors, they outperform by slightly more than 10%
Mhm.
as a historical average.
Yes.
And most investors, 90 plus percent, even professional investors, underperform. So on average, they do less than those 10% per year. So when you start investing, you have those 20K in your bank account. Be realistic in your return expectations. If you invest because next year you need the 30K to buy a
Mhm.
house, for example,
Oh,
it's not gonna work. I mean, don't do it.
no.
Don't do it.
Don't.
You better just work a little bit more. You keep it in
Mhm.
cash. If you invest in stocks, it's for the next couple of decades. And just know that the historical average of the index, which outperforms most of the investors, is around 10%. So
Mhm.
be realistic on what you can get from the stock market. You're not going to get rich overnight. Even 3 years from now, you're not going to get rich. This is a multiple decades game.
Yes. So, do you know what happened? I believe until until 5, 6, 7 years ago, most investors had realistic expectations about what they should expect from their portfolios. And you know what changed the whole thing?
Was
Crypto.
it crypto?
Crypto.
Mhm.
Then those digital assets, you start making 2, 3, 4 times your money within a year. And the expectation from younger investors now is I'm not
Yes.
making, I mean, you get that from your copiers.
You know, just yesterday, I heard, sorry, just
Go ahead.
yesterday, one colleague told me uh, investing is getting rich or dying trying to. But this is not what investing is about. I'm sorry. We all heard those stories. Like there was a truck driver, I think, in the UK. He invested 6 or 7K in Shiba, and then he made a couple of millions during the COVID crazy years of crypto. 2020, 21, he bought 6,000 or 7,000 worth of Shiba, and he became a millionaire after a couple of months. And we often hear those stories from crypto. The problem is that most investors in crypto, they down more than 90 or 95%
Yes.
actually on most of their holdings or on their wealth. And yes, you can have you can be among the lucky ones, but I see it more as a lottery, to be honest, in
It
crypto.
is.
And it's really important not to apply the same logic to stocks. If you buy a stock, you can get rich, but over decades. You
Yes.
cannot get rich over a couple years.
Yes. And having unrealistic expectations can push you to take more risk than you should be, especially if you are not, especially if you are, if you just start investing and then you start using instruments that
Mhm.
they are highly, highly risky, and how you end up wiping up your portfolio. And then what happens? You're not going to start, then you're not going to continue investing. If you saw that you tried it, you lost some money, and it wasn't worth it, then you're not going to start another portfolio. You're not going to start over.
Mhm.
Then you continue your life without missing on this opportunity to put yourself together from the beginning, find a nice strategy, keep it simple, and allow time to help you compound over and over and over again.
Mhm. So one of your big don'ts is then don't look at crypto, don't look at stock the same way people look at crypto then.
You should separate crypto and stocks.
I agree.
If
It's
you think
completely different. Two worlds, two different worlds.
the 100% return for crypto, it's like a 20% return for stocks. Am I right?
Yes, and the reverse is also true. If a stock drops 20%,
89,
crypto worth is 80 or
80
90%
or
down,
90%.
right?
So if you, yeah,
So don't panic. If you're down 80% on your crypto position, it's just like you're down 20% on your stock.
20%,
Over a couple days or a couple weeks, it could recover actually.
20%, 20% of the S&P, it's a big deal.
Mm,
It
it's a
doesn't
big
happen
deal.
very often. It happens every blue moon. So it's very rare. But for crypto, 70, 80%, I think it happens every couple of years, basically.
Yes, for the crypto overall, and for
Crypto.
specific cryptos, it can happen overnight. You
So,
hear some news and then bam, it can just go
so,
down.
so expect
So,
that.
yeah, so definitely expect that. I have one big don't, is actually my last one
Mhm,
that I want to bring. It's don't get greedy with money. So if you need to cut losers, you
mhm.
cut. If you need to take profits because you think this is the maximum reach, you take those profits.
Yes.
The problem is that for most people, a loss affects more than a profit, psychologically speaking.
Mhm.
So know how to value your success and not only the slaps you receive from the markets. So this is really a positive note, this don't. It's not a negative one, it's a positive. It helps you to avoid frustration. It helps you to avoid giving up. So when you have a loss and when you have a profit, know how to value both equally if both are the same amount. The problem is that the loss can affect much more. And so people go into crazy strategies to try to recover. So, for example, let's say you invested your 20K in the stock market, and the first year you're down 20%. It means the year after you need to do at least 25%, but you tend to panic and you tend to be a little bit irritated to have lost already your 20% and you want to recover as soon as possible. And unfortunately, some people do risky stuff and start using leverage or start going into crypto or into higher risk, maybe penny stocks that overnight can do, yes, plus 50%, but overnight it can be also completely wiped out. And if you continue doing those risky trades, you might continue losing more money and you might almost get addicted actually and keep injecting more of the cash you receive from the salary into super high risk and every time in riskier and riskier stuff just with the hope to recover everything you've lost so far. So it's really important. Greed, there are two sides of the coin. And both sides of the coin, unfortunately, are bad. The coin is bad. Just throw it away. Put the greed away. You're in here for decades, and you want to grow, and to grow over time, and to feel how to say comfortable investing. That you don't mind investing today 1K, and that it would be down 20% next month. It's okay. That's gonna happen for sure. That's gonna happen. So don't get greedy. Know when to take your profits, know when to cut your losers, know how to stay in the game. This is really the most important.
Yes. Greed is can make you do some crazy things.
But do you agree? Because a lot of investors are actually greedy, and ultimately, is it not the incentive of the investor when he enters? Is it not greed that pushes you to enter the stock market? I'm asking on purpose a provocative question here. Are you greedy, Demetris?
I am greedy to a point. And there's a fine line you have to walk through to separate yourself. Greedy. Have you watched the movie Wall Street?
Yes.
Greed is good.
You mean the Wolf of Wall Street, right?
No. Wall Street with Michael Douglas and Charlie Sheen. It's a 1980s movie.
No, I'm sorry. I was born after it.
It's a classic.
Yeah, I have to watch it.
There is a phrase in that movie: greed is good. Greed is good. So you have to be a little bit greedy. You have to want more in order to risk your money because investing in the stock market involves some risk. So you have to be a little bit greedy to risk your money, but it's a fine line you have to walk through to stop yourself from going extra greedy. For example, if I was buying heavily on Nvidia while I'm up 275%
with leverage,
that would be crazy greedy for myself, and I deserve to lose everything. But holding that position and sitting on extremely high and unrealized gains, you can say I'm greedy, but I'm not crazy greedy.
You're not crazy greedy. You have enough buffer anyway.
Yes.
So if the stock fundamentals change and it starts going down, and you still could take a huge profit, right? So this is not being too greedy, I think. If you stay invested, you were invested in Nvidia before it became a hype. I know someone who invested at the start of this year. Actually invested a month ago. He's down, I think, 16%. He really invested a lot in it because, I mean, everyone hears of Nvidia. Nvidia is hype and everything, and he invested a lot in that. And unfortunately, it's down 16%. In your case, you invested before it became a hype, and you have sufficient comfort to stay invested, so you don't need to take profit. But if the fundamentals change, you would be ready, right, to take profits.
I'm absolutely right.
And to rebalance your portfolio, right?
Yeah, I can do a complete turnaround in a moment's notice. I'm not personally.
You're not emotionally bound to them. It's not your children, your stocks, right? You don't mind to say, all right, time for you to go away, I'll
No,
get
they
some
are
other
not.
ones.
And I can rebalance my portfolio and I can remake the whole thing in no time. I have no problem doing that. And one more thing, quoting the same movie again. By the way, I think we should do a review on of that movie in the podcast, you and I, after you watched it. We're gonna do a review about it. You're gonna love that movie.
I have to watch. We'll do an episode about it if it's.
Yes.
It sounds great. So
So there is a quote from the movie saying, by the time you read it in the Wall Street Journal, it's already too late. So if you wait for the press, for the news to say buy NVIDIA, it's too late already. You
it's
missed
too late already.
you missed
Yeah.
the game, and now you're just gambling.
Mhm. All right, Demetris. Thank you. I think it was very useful. So if we can do a little recap of what we discussed,
Mhm.
and maybe the main do's and don'ts that you'd like to highlight to someone who starts investing.
Say again.
What would it be in a couple of words? If you had to do a little recap of the do's and don'ts for someone who starts investing, has 20K in savings account, in a couple of words, what we should do?
Number one is start small. Don't risk all your capital in one shot. Just take your time. Keep it simple. You don't have to get into crazy risk management things in order to have a really balanced portfolio and create wealth for yourself. It can be done without using complicated instruments. Do not take advice from anyone. It has to be your own convictions. This is my number one don't. It has to be your convictions. I don't care if your mother told you buy NVIDIA. You're not buying NVIDIA. If you respect someone, your mentor or whatever is giving you a tip, it's up to you to follow the tip. But I don't take tips and I don't give tips as well. I don't take and I don't give them. So, and don't try to pick the timing. That's my another big don't. Don't try to pick the timing. If you think Microsoft is going up because it has solid fundamentals, then you buy it when you buy it. But don't wait for something to happen and you're gonna buy on the exact day, because we all like to, if you buy a stock one day and it goes up the next day, you feel like a genius. You feel like, oh, I'm good.
Exactly. And that's called overconfidence.
Yes.
Right? And then you get greedy.
Yeah, don't get used to that. Doesn't happen very often. That's just luck.
That's just luck.
That's just luck.
That's just luck. So be humble. Be humble. Don't be overconfident. Be a bit greedy. Don't get too greedy. Have a plan. Stick with it. Don't try to time the market. And always be realistic with your return expectations. Don't trade too often. And I think you'll be just fine.
Yes.
Really, if you listen to our episode and you re-listen to it, and then you start investing in stocks, I think you'll do just fine.
And you know what? We agree in almost everything. Even though
I think all the seasoned investors would agree, actually.
agree with that, right?
Because ultimately being an investor is not about being smart or being a good mathematician or being a good journalist or whatever. No, being an investor is a way of being.
Yes.
I think it's about you as a person, how you are in the market. So it depends on your personal qualities. So if you're patient, right? If you're also a little bit opportunistic, right? You have to be a little bit driven by greed. This is important. But if overall you're patient and humble and you're always ready to learn, I think you'll do fine.
I think so too. I think your experiences, your life experiences build your character, and it comes down to character when it comes investing into the stock market, because the market is gonna get the best of you, even if you are the best of the best. Sometimes the market will get the best of you. So you have to be prepared and stay humble.
And stay confident also in yourself.
Yes, stay confident in yourself with your convictions, but at the same time, Exactly. It's a fine line to walk, to be confident, but be humble at the same time. Not too many people can do that.
Mhm. Mhm.
Would you agree?
So my biggest advice is if you have those 20K and you want to put them all today, before you do that, make a couple of appointments with
Mhm.
psychologists, with
Mhm.
therapists, with your ex-girlfriends or ex-wives.
Yeah.
Try to see where, your character, maybe there are certain
Mhm.
things to improve. Talk with your relatives, ask them, what would you say about me? And if everyone says, yeah, you're a little bit overconfident at all times,
Mhm.
you're a bit too greedy, then be careful with that, right? And apply measures to your plan to which you will stick to make sure to not be greedy when you're in the market, to not be too overconfident when you're in the market. So that's also a good tip probably I would give. I'm joking, but it's a serious tip
Mhm.
actually. Ask people around you on the things that they think perhaps you could improve in
Mhm.
your character. If they say that you are too stubborn, you make your opinion and you never challenge them.
Mhm.
Careful,
Be,
careful.
be very careful entering the market when you're stubborn. Yeah,
If someone calls you stubborn, you have to be careful.
you have to be careful.
Uh,
And since we're talking about greed, um, let's finish it with a quote. Bulls, bulls make money, bears make money, pigs, they get slaughtered.
I think it sums it up perfectly. It sums it up perfectly. Thank you, Demetris, for the quote. I really love it.
Mhm.
And guys, do leave a feedback. There's
Mhm.
the Q&A. You can ask questions. You can leave a feedback. I know a lot of people come and text us or come in person or call us to give little feedback about the podcast. I'm actually really happy. There are a lot of people that watch it, so I'm really
Yes,
happy about that. And if you love Dimitri's quotes, let us know because we plan to continue anyway
we're gonna
to
continue
really.
anyway. And if you guys want us to review the movie Wall Street, I'm gonna have Akim watch it. It's a classic, by the way. It's a Wall Street investing classic, and we're gonna talk off the air. And if people
Uh,
want it, we can review it.
I will try to watch it. And guys, next week we have a very special episode. We have a big profile investor as a guest. So
Mhm.
this is our first guest in the show. It's an investment director at Morgan Stanley. So guys, stay tuned. She has a lot to say, and we're going to talk big tech next week. Thank you guys for listening. Cheers. Bye bye.
Thank you, guys. See you next week.